love data. I love what it does and what the impact that it has on our profits, the outsized impacts on our profits. So as long as I'm allowed to continue playing with large sets of data and applying it to real estate, I'll keep doing real estate. So far it's worked well for us. We have about 800 investors. The portfolio is about $1 billion spread across 10 states, and lots of our properties are in markets that you've never even heard of.
That was Neal Bawa, the CEO and founder of Grocapitus Investments and the CEO and co-founder of UGro Investments. In today's episode, Neal will tell us about the big data he's using to find incredible opportunities and locations you've never heard of. Stay tuned. The limited partner shares in the potentially outsized returns of a well-planned and executed investment, but as a passive investor, and has the maximum leverage on their most precious asset, their time. And that is why we're here together. 90% of the millionaires out there built their net worth with real estate. However, 0% of the billionaires are hands-on managing the real estate assets because there simply isn't enough time. My name is Jake Wiley, and for the past 16 years, I've been investing in real estate, and I've learned a thing or two. But the most important lesson is how to leverage the expertise and time of others to maximize your investment potential. Welcome to the Limited Partner Podcast. All right, welcome partners again. This is your host, Jake Wiley. This week, I'm joined by Neal Bawa. So Neal, thank you for being here and welcome to the show.
Thanks for having me on the show. Very excited to be here.
Yeah, I think this will be a great conversation. And you may or may not know this about me, but I'm a data geek myself. I love making decisions based off of data, and I think we're going to go into a really deep and interesting discussion that's a little bit more data focused in the past. But also, we're in a changing environment, so I'm kind of excited to have that conversation with you. But to kick it off for our listeners, if you wouldn't mind, let us know a little bit about your background and how you got to where you are today.
Sure. So I'm a data scientist, computer science graduate by profession. I've had a full tech career, 14 years long. Exited a company that I took from 10 employees to over 400 employees at exit, and really got into real estate to invest my own profits. I live in California, so I was paying 40 to 50% every year in tax, and I realized the benefits from real estate. Got involved in real estate through meetups, that I held at the technology business that I was running. They had large classrooms and conference rooms, and so we started doing meetups there, and that sort of snowballed, and I started to write algorithms, data science algorithms, for how to figure out the best cities and neighborhoods in the US. Other meetups started inviting me to present those, eventually first in the San Francisco Bay Area, then everywhere in California, then everywhere in the US. And now I've presented at over 100 conferences, both virtual and physical conferences all over the US. So I love data. I love what it does and what the impact that it has on our profits, the outsized impacts on our profits. So as long as I'm allowed to continue playing with large sets of data and applying it to real estate, I'll keep doing real estate. So far it's worked well for us. We have about 800 investors. The portfolio is about $1 billion spread across 10 states. And lots of our properties are in markets that you've never even heard of.
Well, I think that's really fascinating, right? Because a lot of the times on the show, and my listeners out there, you've heard this, we talk about finding the right partner to work with, the operator that's got in-market intelligence. And, there's a bunch of markets all across the US, the Sun Belt, we all know where they are, where everybody's investing. And, you're talking about looking at data differently to make decisions and not necessarily being in the market. So I'd love for you to peel back another layer on the onion for us on exactly what that looks like and how that works.
Sure. So what we do is we have a team, a data science team that's 3 full-time employees. And these people, they are constantly grabbing data from over 25 different locations. And they aggregate the data in 2 or 3 different softwares. They massage it, and they rank cities and neighborhoods across the US. So about 400 cities, about 6,000 neighborhoods in terms of profitability, in terms of the ability to grow rents, the ability to grow in terms of per unit prices. And so they rank those metros, and then we assign risks to them. As you can imagine, smaller metros that are not close to a major metro have higher levels of risk, But then the major metros also we assign risks. And this is the part where we feel we are really different. What I find is not being done in the US is as multifamily prices have gone up, the risks of the larger metros have gone up. So in 2009, the price per door of multifamily was $62,000 a door. Last quarter, it was $192,000 a door. So 62,000 in 2009, last quarter 192K. So it's fair to say that it's more than tripled. Well, rents haven't more than tripled over that time. They've basically doubled, almost doubled over that time. So the challenge is that valuations are running way ahead of rent increases. And traditionally, multifamily was a rent-based business. Rents go up, valuations go up. But today, valuations have separated from rents. They've become their own beast. And so that creates risk. And some of the largest metros in the US actually have significant risk created by this separation, this detachment of logic. And so we rank those. And what we found actually, and this is very interesting, is that as we started ranking risk, some of these better known metros in the Southeast actually started to prove to be higher risk than some of these smaller metros, which obviously have been risky in the past simply because they're away from larger job growth metros. And so our risk profile started showing us that these smaller metros were actually producing higher profits at lower risk. And so we started to make tentative investments in them. Initially, like everybody else, our bigger investments were in major metros like, Dallas or Atlanta and so on and so forth. And so we started to dip our toe into this, the use of data science and say, okay, so if you make an investment in this little metro that nobody's ever heard of, how does it do? How does it compare to our bigger metros? And how risky is it, right? Where's the risk and where does it sit? So, places like Idaho Falls in Idaho or St. George, Utah, or Dalton, Georgia, these kinds of metros that weren't necessarily the blockbuster metros, but as our data was showing that the supply demand gap was much larger than the bigger metros where people were paying up so much more that the profits were really getting squeezed out. And it's proven to be incredible for us because we've now exited 7 projects at a 36% IRR. And I can tell you the bigger IRRs that led to that 36% average came from the smaller metros. We haven't had a smaller metro that we have had significant challenges in. We haven't had a smaller metro that we haven't hit our pro forma in. We've had a larger metro that we haven't hit pro forma in. Why? Because you've got to pay up. And so the use of data science is allowing us to continuously find metros. I'll give you some examples of metros that I'm interested in today that you've never heard of. Once again, I just named a bunch of them, but those were older ones. I'm talking about previous projects that we are exiting now or have exited. Today, some of the most interesting metros in the US are Rogers, Arkansas, and Port Charlotte, Florida. Now, you don't really think about these, but that's what our data is pointing us to. And so that's what we are. We're a bunch of data geeks that are partnered with 800 investors. More than 400 are technologists in the San Francisco Bay Area. And they understand that big data often has weird conclusions, crazy conclusions, stuff you wouldn't see, stuff you wouldn't think of. But it creates an outsized amount of profit, especially in an environment where everything is so expensive.
So I want to dig in a little bit because I think this is super fascinating, right? Is that there's so many people moving into these markets. So actually, I'm going to slow down and ask one question at a time. So why do you think that there's been this separation of rents and values in the larger metros? Like what's driving that?
Demand. I think that what has happened is in the year 2000, 22 years ago, 5% of institutional portfolios came from multifamily real estate, right? And other forms of commercial like office and retail. Today, that number, astonishingly, is almost at 20%. And when you interview the major institutional players in the US, they say that over 10 years, they wanted to go from 20 to 40%. Right? So they've come very far. So they've come from 5% of their portfolios being real estate to 20. So they've already quadrupled the real estate component of their portfolio. And now they're saying over the next 10 years, we don't want to go as quickly as we've done in the last 15 years, but we still want to double that portfolio. So there's demand. Now, amongst those demand buckets, in the year 2000, office was two times the size of multifamily in terms of transaction volume, right? Today in 2021, so at the end of 2021, there were $221 billion in multifamily transactions. And you might say, office, how much? Well, 35 billion. So you see how multifamily, which was much smaller than office when it came to institutional portfolios, much smaller in the year 2000, is now between 3 and 5 times larger. Now, of course, office was hit very hard last year because of hybrid work and remote work and things like that. So it'll come back. But what is astonishing is in the last 10 years, especially, we've seen multifamily become the biggest, by far, the biggest, the 800-pound gorilla when it comes to all sorts of commercial assets. And this, when you combine this with its outperformance through the pandemic, obviously office didn't perform well, hotel didn't, multifamily has performed really well, has made multifamily a preferred asset class for institutionals. And because there's so much demand, there's so many people that were buying office before that want to buy multifamily now, that we have seen this separation where these properties are not just no longer just based on rents but based on demand. So if there's too much demand, too much money in the market that is chasing a small number of assets, they're going to get bid up. And we're seeing that in pretty much in every metro in the US. Even in the tertiary markets that we're in that nobody's heard of, we're still seeing that bid up happen, but it's nowhere near the big markets like Phoenix and Austin and Atlanta, these superstar markets where you've seen prices more than triple since 2009.
Yeah, and I'm just going to ask like one follow-on question there. So in terms of like institutional, the way the institutionals have always invested, they've always been class A, very, very like static returns. They're looking for a specific thing. Has their investment requirements like changed, or is it just because there's so much more of this institutional capital coming in at this kind of lower return rate that they need because they're used to investing at these levels, that it's just changing the dynamics of the market? Does that question make sense?
Yes, and I think the big institutional players, right? So, the folks you're talking about are the folks that invest 10 billion to $100 billion, right? So that level, they've been forced to go lower down in the stack, kind of move away from just Class A for two reasons. Number one, Class A used to be a 5 cap product. Today, it's more like a 3.5 cap product.
Mm-hmm.
Even with interest rates going up, we're still seeing Class A at 3.5 cap. Essentially, what that means is you're paying 30 to 50% more for a Class A on a per door basis than you were, let's say, 6 years ago. So they're getting less for their money than they were 5 or 6 years ago, forcing them down stack. So instead of Class A, they're going into Class B. And second is lack of product. Even on the Class A side, there's just not enough product, so they're basically doing it even though they don't want to. So what's happening is institutional players are more and more getting into the traditional syndication area where B properties and C properties used to be syndication, A properties used to be institutional. Now it's just a free for all. Everyone's in everyone else's seats, and we're even seeing institutionals for the first time ever buy Class C properties. Now they're buying very large Class C properties in very high quality areas, but and they're buying portfolios. But we've seen institutional players buy 1,000 units of Class C at a time.
Well, that is fascinating, right? Because I live in this world, and I wanted to hear it from you. But when we think about the institutional players and the way they're moving into these markets, they have allocations of how much money they need to move into these markets, and we're talking about billions of dollars that they got to put to work. It can't be parked. So, working and even getting a lower return is better than parked and making zero return. So they are forcing this market in a way. So I think that's a really key point that everybody needs to know. And you've seen that, and you've seen this cap rate compression, as you mentioned, down in, low threes. Like I think there's times where it was touching the twos. I think it's coming back. It's stabilizing a little bit, but it's been a really interesting market, especially in the B's and the A market type properties.
It has been, and one of the things to understand is the amount of demand is so staggering, right? So the US grows, our population grows at 0.5% a year at this point. Last year, we only grew at 0.2%. Our inflation most years tends to be 2%, right? So this year it's 8%, but most of the time it's 2%. So you'd think that these kinds of markets would grow at 2%, 3% a year. But multifamily volume, transaction volume in dollars doubled in 2021 over 2020, more than doubled actually. And this year, it looks like it's on track to pretty much do the same numbers as last year because of such a huge number. So obviously, that doesn't resonate in a country with a 0.5% population growth, 2 to 3% inflation. If you're seeing occur in a year, there's other at play here, and the factor is very simple. When COVID happened, the government basically made money cheap. And so these big players loaded up on the money. They loaded up on billions or tens of billions, and in a few cases, hundreds of billions of dollars that they basically took from the market because the money was cheap, and they loaded themselves up. And now they're looking to buy assets because they need to provide a return on that money. And because they loaded up on cheap money, they actually can take lower returns. And so they're okay with these crazy cap rates that you just referred to in the low twos. And yes, you're right. Now things are adjusting. For your limited partners that are listening, they may not really understand what happens when cap rates go up by half a cap, but essentially prices go up by about 10, maybe 15% adjusted for rent growth. So we are seeing that 10 to 15% adjustment happen in the market compared to Q4 of last year, which was just completely nuts. But that still leaves multifamily prices significantly higher than they were 2 years ago because they've gone up. The US 14.8% increases in rent, as much as 30%. Austin being at the top, so is Phoenix. Now it's Miami at this point in time. Miami is the fastest growing market in the US in terms of rents, where Phoenix and Austin have cooled a little bit from this crazy growth that they saw before. But overall, for the US, we're at 15%. Keep in mind that the historical 30-year annual rent growth rate is 2.5%. So in the last 12 months until the end of May 2022, we have seen 6 years of rent growth in a single year. So even as the market is cooling because of interest rates going up, which means debt is becoming more expensive, the fact that we've had 6 years of rent growth in a single year is giving confidence to these institutional buyers to keep buying because they're like, I'm going to buy this and then rents will go up further. I don't know if they will, but so far they've been proven right. And so that is not happening in other asset classes. Rents are not increasing by more than a few percent in office, in retail, in senior housing. This is only happening in multifamily and to a smaller extent in self-storage. So the money continues to focus on the multifamily market because they're seeing outrageous, ridiculous increases in rents.
Well, I want to switch gears here because this is where I think it gets really fascinating. So we're looking outside of these major markets where all this money is flooded into, and you're finding assets through your data and your analytics and that are popping to the surface that nobody would know about. So this kind of reminds me of a conversation I had with Paul Moore about self-storage, right? And some of the things that the reasons he thought that there's a lot of value there is because it's more of like a mom and pop type of operation. And you can find these things and there really is some value add and there is some juice to squeeze. There's still juice left to squeeze in some of these lemons here. So is it a similar concept when you're looking in kind of these smaller markets? Is like, yes, like there's opportunity to buy from maybe some mom and pops. There's still opportunity for a good value add play. What does that look like?
So there's two kinds of plays there actually. So Paul Moore and I, he's a friend of mine. We talked about self-storage a while back, and I dabbled with it, and I wish I'd done as much as he has, because he's right that particular market, the cap rates are still significantly higher, which means prices are significantly lower per door than they are for multifamily. So there's more juice there, and I've been basically addressing it from the perspective of these markets. But here's something else that's happened. This is the part that I never hear about in podcasts, and the reason for that is if you took a room and I filled it with 1,000 syndicators, maybe two or three out of that 1,000 are actually building new buildings, right? So syndicators, their mindset, their knowledge set is only related to existing buildings. And so sometimes they fail to see why buildings are going up in certain areas and not going up as much in other areas. It has to do with the cost of construction per unit. So a lot of these smaller markets in the US, they for until maybe about 2017, 2018, the cost of construction was about $100,000 a unit. Okay. And today, because of the crazy inflation that we've seen in construction costs, in a smaller market, you still cannot make a new multifamily unit for less than 200,000. So it's jumped from $100,000 a unit to $200,000 a unit in 4 years. What this means is in these smaller markets where rents have not yet risen this, as much as they have in the big markets, it's impossible to build new product. It simply isn't, because if you build this new product, rents have not risen enough for you to make any money or break even. So it would be silly for you to basically build these new units. And so we have this supply demand gap where rents have to go up about $450 a unit in these smaller markets for a developer to consider building anything, smaller, bigger apartment complexes. And that is the biggest opportunity in America today. That's the one that's left over. Smaller markets, $450 gap on average between what their rents are today and what their net rents need to be for new competition to come into the marketplace in the form of new construction. And I am buying as many buildings as I can in as many of those markets, because I know that if new construction cannot come in and break even, rents will go up. Because if these markets, and I'm only buying in markets with very strong population growth, a lot of the markets that I'm buying in are in the top 1% in the US in terms of population growth. So there's people coming into these markets. And unlike major markets where there's 350,000 units of new construction that's happening in the US right now on a per year basis, less than 1% of that is happening in these small markets. So that gap is incredible. It's like I'm in a position where I know I'm going to win simply because it's not possible to do new construction. No lender will approve your construction loan because they know that rents are not high enough because construction costs have gone up. So until those construction costs move up to that level, these markets are practically bulletproof. Like Killeen is a market that's 52 miles from Austin. Austin's the hottest market in the US by, 80% of measures that we use to calculate show Austin as being the hottest market in the US. The remaining 20% show Phoenix as being the hottest. And so this market's about 50 miles from Austin, where we've seen 30 to 40% rent increases. And in this marketplace, the cost of construction rents don't work. So I'm buying these value adds and I'm able to push rents up by 10% a year, maybe even more, 15% a year, simply because what alternative do people have? It's a very fast growing market. It's got both military and it's got people that are moving out of Austin because Austin's so ridiculously expensive now. Take that example and apply it to dozens of small markets in the US, and you see just this incredible opportunity that just does not exist anywhere else in the US.
So I want to dig in on that a little bit, because let's talk about that $450 gap. So what is the rent that exists in those units today? Because I live in Charleston, and like if somebody raised the rent $450, like it just wouldn't surprise me at this point, but in these smaller markets,
Yeah, so Charleston is one of those markets, right? So, when you look at this corridor from Charleston to Myrtle Beach, there's a number of small markets that we look at, and then we haven't invested in Charleston because we have others that we feel are better. Bottom line is, a lot of these markets today, if you're building new construction at 200,000 a unit, Jake, your rents have to be at $1,600. If you cannot underwrite $1,600 to $1,700 in rents, you are not building that building because no lender is going to give you money, right? So we're talking about markets that are in the $1,200 in average rent range, and that market needs $1,600 for new construction today, right? That gap, that $400 gap, I'm not suggesting that this gap is going to be just filled up in a year, right? But if it gets filled up in 5 years, I'm delighted, because most of the projects that you do and I do that have been stranded value adds, what have we told our investors? We've said we'll go in, we'll spend $8,000 a unit, and we'll bump rents up by $150 to $200. These days, more like $200 because your rehab's more expensive. If And so if my business plan is to rehab units and bump rents up by $200, but I have this $400 delta that doesn't require any rehab. If it gets achieved over 5 years, I'm a very happy camper because I have way surpassed my pro forma. And typically we do go out and do that rehab anyway, just to make the velocity higher and just to make our units more attractive. But in so many of these markets today, you have that $400 gap that you can make over 5 years. And that's really what we are focusing on at this point in time. I love the big markets like you. I want to own in Atlanta and I want to own in Austin and Dallas and blah, blah, blah. I'm just not willing to pay what people are forcing me to pay today. So I'm using data science, I'm leveraging it, and it's working wonderfully for me so far. I'll give you an example, right? So last quarter, the average price for units per door units in the US was 192,000, right? So obviously, if you're buying in California, it's probably 400,000, but 192,000. And in the Southeast, it was somewhere around 220, 230,000 a unit. And in February, I was still buying at $130,000 a door. But I'm buying in a market that has the same construction cost as people paying 220, right? So I have this $90,000 a door delta, and obviously some of the fact that these units are cheaper is because their rents are lower. So I'm not saying that this is some magical thing. Their rents are lower. But once again, remember, the problem that Atlanta has is the same as the problem that my small market has. The cost of construction is at 200,000 a door. So I've got the same benefit, but I've got rents that are starting off a much lower base. Now I've got the ability to run them up over time. As long as I'm patient, I'll get there.
Yeah, I mean, you really brought out the points, and I want to hammer this home because I think this is so awesome, right? So when you think about what you're talking about, a $450 delta in a $1,200 a month unit, right? It's not possible that that's just going to be absorbed in a year, in 2 years, right? And you're saying you've got a 5-year plan on this thing. It's not possible. But until that delta is absorbed, there is not going to be any new construction, period. Right. So the market
Nope, because you can't underwrite for it and you can't get a loan for it. Right.
So if you have
anyone looking to build new units, right? Everyone wants to make money, right? So there's no developer interested in these markets because there's no money to be made. And that same developer can go 50 miles further or 100 miles further to a major metro and build the same $200,000, unit, cost of that unit and get his profits. So why would they come to these smaller markets? So it's one of those chicken and egg situations that unless rents go up, developers are not interested.
Yeah. And I mean, that's the point, right? Is that until the rents go up enough, which is probably, like you're saying, 5 years down the road, and you have a market with net positive population growth, the only thing that can happen is rents go up. Like that's it. Right. And
there's no other alternative that we're aware of, right? Because single family homes in those markets are even more expensive than multifamily. So it's not like that's going to fix the problem. And these markets are too small for there to be large scale programs that will fix the issue. So that's one of the reasons I like the smaller markets. And, I was careful about them before COVID, but post COVID, what I'm seeing and everyone's seeing, and it's been discussed in your podcast, is that more and more people are leaving the major cities. So here we are, more than 2 years and 3 months after COVID started, right? Technically, we're supposed to be, the pandemic's done. We're in the endemic phase. Why haven't people returned back to the offices? City after city is saying, hey, our back to the office initiatives are failing. Seattle did an article yesterday about this, that only 60% of the people that were swiping their key card in their offices before COVID are swiping them today. And there's a significant portion of the workforce that simply will not come back full time. That train, it's that time for that has passed. And as a result, America is going through a one-time shift where a significant portion of our workforce is becoming mobile, right? Because they can afford to do it, and because there's no longer a block in the minds of CEOs. And people are being allowed to work from anywhere. I mean, what's interesting is my son's 21 years old. He has a job offers from Accenture. They want him to work in Austin, but he can work from home, right? He can work from home. And it's like, we just want you to be in Austin because you can, check into the office a couple times so you can attend our parties and things like that. And if you have a major event, you can show up. But otherwise, you can work from home. We don't particularly care. And Accenture has 700,000 employees, right? So this is happening in real time, and it's so big that people just fail to wrap their head around why this is such a big deal. This is the biggest change in the way that we build and manage real estate since the US freeway system was built in the 50s. It's enormous. It's massive. And I think most people just fail to understand how big a deal it is. And so these smaller metros have an advantage because they, obviously their rents are much lower. I mean, I'm talking about $1,200 rents where Austin's already at, $2,500, right? So there's people moving from Austin to Killeen, which is just 52 miles away. And a bunch of them are still living in Killeen, and they're driving down to Austin, to North Austin, to work there. And they're okay with that because they're not going into work 5 days a week anymore. They're going to work 2 days a week. And so this change, this dispersion that's happening is happening in real time, and people are not quite adapting their strategies to it because they're not looking at the data every week the way that our data science team is.
Yeah, and for those of you out there listening that have any doubts on what Neil is saying, check out my recent podcast with my mentor Byron Carlock, who talks about what he's calling the rural renewal, which is a very similar concept here. Is people are choosing to live in places that they want to live, not where they've always been forced to live in the past. So, I mean, this is not Neil saying this on his own. This is a real thing. So go check that one out. But Neil, I'm gonna switch gears on you a little bit again because we're obviously in flux here in the market, right? The news, you go back in time, go back a year, and like everything was just rising. Things are changing, right? The Fed has been, raising rates. We've got a war in Ukraine. For us limited partners out there, what should we be thinking about over the next 18 months to 2 years?
I think the next 6 months are very are the dangerous months. So if you're a limited partner, please understand this. When you're making an investment into a multifamily, especially a value add today, you're taking a significantly higher risk than you were 6 months ago, significantly higher. And that risk is that the price being paid for that multifamily has not adjusted enough for this new reality of high interest rates and low LTV. So, previously you might have been able to leverage to 75% and have 25% equity. Now, a lot of lenders are saying, no, we'll only give you a 65% loan. So bring in more equity. So there's just no scenario that I can possibly imagine with me or anyone else where returns don't go down. Returns are in flux. They must go down because I have seen no evidence whatsoever of prices adjusting according to the increase in interest rates, right? So as interest rates increase, the prices should adjust. Well, they've adjusted a teeny tiny bit, but they haven't adjusted to account for all these increases. And there's further increases coming in interest rates. Now, I feel very, very strongly that these interest rate hikes are temporary. The U.S. is addicted to low interest rates, and so is the rest of the world. By the way, we're not unique in this. And so I do expect that rates will be falling a year or 18 months from now. But in the meantime, when you make those investments, those may not be the best. In fact, I've told people, look, this may not be the best time to invest in multifamily, and you might want to wait for 3 to 6 months. The market will adjust. Fundamentally, multifamily is in an incredible place, right? So there's that institutional demand that we talked about, and there's the massive rent increases. So you're in a very, very strong market. In fact, compared to stock, bonds, the NASDAQ, and crypto, and you're going to see, I mean, real estate's the only market that has not seen a substantial decline. I think that prices are down maybe 3 or 4%, maybe 5%, depending upon the market. But, the NASDAQ's down 32%. So you can see that the quality of the product, but at the same time, there's a price adjustment that hasn't yet happened, and you're in the middle of it. So this is a time to be careful. And when you study the projects, the big question to ask your syndicator is, why are you buying now and not waiting 3 to 6 months, and make sure that the answer being provided is robust. There are many projects where it makes sense to buy today, but I would say that for every project where it makes sense to buy today, there are 10 where it makes sense to just hold off. because because the price still, in my opinion, is a little bit too high and it has to adjust.
Well, I'm going to go on a little deeper on that one too, because you mentioned that it's different than it was 6 months ago. So let's just say we bought at a 3 cap 6 months ago. Is that investment still okay because of the way the debt was
I think that
structured and other things?
investment's okay. That investment, I think, is okay because you've had 6 months of furious rent growth. So if from Jan 1st to May 30th, typically the US would see about a 1% rent growth, and we are seeing half of 14.5%, so that's about 7.25% in that time frame. So the people that did buy in January, they're going to be okay because of the rent growth being so strong, right? But if it wasn't for that rent growth, I think they overpaid, because the vast majority of syndicators are buying, including myself, by the way, are buying using something known as a bridge loan. And that bridge loan is usually not locked in, right? So that basically the bridge loan, the interest rate on that goes up as interest rate as the Fed is raising interest rates. So there are challenges with those projects. So I'm very happy that I wasn't buying 200,000 a door. I was buying 130,000 a door in January. So my exposure is very limited by the fact that my rents have gone up just as much as everybody else, but I didn't pay 200,000 a door. I paid 130, which means that my interest rate bump is much easier for me to swallow. So I think some of those people in January are going to be challenged. I think cash flow is going to be affected across the board in everyone's properties. Um, but today you know what the interest rates are, right? So you have the knowledge, right? Your syndicators, they work hard, but they can't predict the future, right? So they didn't really know that this crazy war would start and it would shoot up oil to 150 bucks and all of that, all of the knock-on effects after that. But today they know. Today they have a good sense of what's happening in the marketplace, and so to be very careful about price per door compared to where they were in January.
And I think really I just want to hammer home too that what's in flux in the multifamily, really in commercial lending, is lending. It's the debt markets. The debt markets are in flux, and there's really no way to. So, like the equity structure is the same, but you're saying like it's very possible that you might have to bring more equity into the deal, right? Which is going to impact it. The debt could be on a floating interest rate, which could be fluctuating. And I have heard specifically firsthand that the bankers don't even know what to do right now, right? So they're pricing almost in like a worst case scenario, like they're just guessing, and it's a really weird
Yeah.
time right now. And to your point, is like 6 months ago, there's some certainty that we're in the middle of this kind of like weird flux where everybody's trying to figure out like what is going to happen. And as a result, everything that's happening in this kind of short period of time is like super in flux, right? And there's a lot of risk because, one, there might be more equity requirements. The debt rates could go up. The debt rates aren't fixed. They could be very short term. They could, and another thing that's coming up is on these bridge loans, there's a lot of bridge loans that are going to be coming due, right? Like they just naturally are timing out in this time period. So there's opportunity there, but there's also a lot of risk of like you had a performing asset, and there's always this assumption is like, yeah, when my 3-year bridge loan comes up, we'll just refinance it into something else, and that may not be really
Right.
even feasible right now.
Well, I'm not sure if it's so any bridge loan that's adjusting because the property was purchased 2 years or 3 years ago. If I don't think that's an opportunity. I don't think that those people are going to go out of business or lose their properties because they have been holding a property in the greatest single rent increase in history. So their rents have increased enough where the impact on all these properties that are coming up for renewal on the interest rates is simply that their cash flow is going to go down a lot, right? But I simply don't think that enough of them will go out of business. I mean, if your property had a 15% rent growth in the last 12 months and you're still going out of business because of interest rates, you've mismanaged the property in some other way. Because we live in a world where we underwrite for 3% increases in rent, and we've seen 15, right? So I think that there was a lot of benefits for people that were holding them during this 2-year time frame. So if it comes up, sure, they'll suffer, their cash flow will go down, but they'll still be liquid and they'll still be able to move ahead. So in my mind, there's no point in saying, well, you might see a lot of properties come to market because of distress. That distress is simply non-existent. But having said that, I think that the cash flow is going to get affected, and there's going to be things that are going to slow down. The debt market, you're completely right. Currently, the debt market is basically taking the absolute worst case scenario because that's their default when they don't know what the heck is going to happen. So I can tell you by December, the Fed will be done raising rates. Now, at that point, they may not start cutting them. Remember, the last 61 years, the Fed has raised rates 9 times, and all 9 times it was sharp up, sharp down. Only one plateau in 61 years, and that plateau was only 9 months long. So most of the time, the Fed brings you as close to a recession as it can possibly get away with, kills inflation, and then starts to reverse themselves. Anyone can Google this for 5 minutes, and you'll immediately see that high interest rates are not sustainable. Right? They're there simply to slow the economy down to almost zero, and that's what kills the inflation. So I do expect that by December, the Fed will offer forward-looking guidance of what interest rates are going to look like, and that's going to allow lenders to stop using worst-case scenario, which is why, even though I expect the US economy to be weaker 6 months from now, I expect the debt markets to be stable in 6 months, because the debt markets are not looking at the best case scenario ever anyway. They just need to have certainty of what the Fed is going to do before they can be more reasonable in setting their rates. And I think right now they're not being reasonable.
That's a great point. Well, who knows what's going to happen, but I do agree with your sentiments there. So we're going to change lanes again here. You've got 800 investors that you've worked with. What is the number one thing that you wish limited partners knew or they had education on before they got into the game?
I wish that these limited partners often tend to put us up on a pedestal of some sort, like we're these magical or mythical creatures. And to me, I think what's more important in letting them know is we're just like you. We're just like you, and we have more time and you don't because you're working a day job. And we experiment. We, take 2 steps forward, we take a step back. Sometimes we take 1 step forward and 2 steps back. And I feel that them knowing that we're just as human as they are is going to make them better decision makers. Right. And unfortunately, the returns have been so astronomically high in the last 2 years because of all these price increases that we've been talking about, that we've gotten this cult status, which is not defensible. It's not acceptable. It doesn't make any sense. There's no magic wand that we have that allows us to ever generate those kinds of returns again. So I think the one thing I want my LPs to know is, hey, we're human. And as a group of 10,000 syndicators, we didn't really generate most of these returns. Maybe we generated half of them through our hard work. The other half really came through a bizarre event called COVID, which led to market liquidity, which led to massive rent increases. So accept that and know that the asset class is still the best in the marketplace, but it can't do what it's done in the last 3 years.
So maybe a follow-on point there too. So if you're as a limited partner out there, you're interviewing potential sponsors, GPs to get involved with, look for a little bit of humility, right? If somebody's claiming that they were fully responsible for the massive growth and the significant upside that you receive from working with them, or some of their investors have, might not be the right person to work with. A little bit of humility.
No, and I think they'll make mistakes because if they believe that they generated those returns, I think they're going to overpay for those assets today, because the same market phenomenon that led to them, crushing their returns is now leading prices downwards. And that force is bigger than any syndicator in the US. It's bigger than all of us put together.
That's right. Well, Neil, this has been a really great show, and I know we've actually gone a lot longer than I anticipated, but I love the conversation. I love the data. I love opportunities that we don't hear of, and like you mentioned, you don't hear this on podcasts, so you heard it here, folks. The last question I usually ask everybody is I always like to end my show with gratitude, right? We didn't get here by ourselves, kind of getting back to the humility piece. I would love to give you an opportunity to give a shout out to somebody that maybe give you a leg up along the way, that maybe you didn't deserve, or, just really made all the difference in the world to you.
That's interesting. So many people to thank. It's hard to, kind of whittle that down. But I think that if I had to give a shout out, I would still give it to the author of The Miracle Morning. His name escapes me for the moment. I tell people The Miracle Morning is not the best book in the world. And it's not likely to even be your favorite book, but it is the book that enables you to find your favorite book. And it enabled me to find my favorite book and to move forward in this role of a data scientist that's made money for my 800 investors. So, the author of Miracle Morning has my gratitude, and it'll come back to me in a second. His name,
Hal Elrod is the author of The Miracle Morning.
Hal Elrod. Thank you.
So Hal, I hope you listen to this and you heard that you made a big difference. Well, Neil, this has been a great show. Like I said, we've learned a lot. How can my community get in touch with you?
I think one of the best things that I'm blessed with in life is I'm the only Neil Bawa on the World Wide Web. So if you type in Neal space Bawa, all the good comments are about me and all the bad comments are about me. I haven't seen any bad comments, but I'm sure it's only a matter of time. So bottom line is that's a good way to start, and then maybe you want to apply a word beyond that when you're searching on Google. So Neil space Bawa space data science is a great place to start if that catches your fancy, because we publish an enormous amount of data science information on these tiny metros that I've been talking about. If you would like to know how we use virtual assistants, we're the syndicator that uses the most number of virtual assistants in the US. We have armies of them. You can type in Neil Bawa virtual assistant. And if you'd like to know what our city picks are, you can type in Neil Bawa real estate trends. We do an event in January that we invite about 10,000 people to, that where we share the big trends and how those are driving pricing in the US. It's a little geeky, but it's very profitable.
That's awesome. Well, Neil, thank you for all of that. This has been a great show. I really enjoyed it. Thank you for being here.
Thanks for having me on the show.
I hope you've enjoyed today's episode, and I'd actually love for you to contribute to a future episode. If you have a question you'd like answered, or a topic or a guest to bring on the show, please email me at jake@thelimitedpartner.com. Now I realize there's a lot of lingo that's thrown around on these shows, so I've created a cheat sheet for you with the top 26 terms that come up most often. Head on over to thelimitedpartner.com/lingo for the list. Enjoy, and we'll see you next time.